Hi, welcome to my channel, Second PUC Accountancy, Learn, Understand and Excel. Today I am going to work out fifth sum under dissolution of a partnership firm, which is for 12 markers with a very important adjustment. So today let us see fifth sum under dissolution of a partnership firm. Rashmi and Geeta are partners sharing profits and losses in the ratio of 3:2. Their balance sheet as on 31st March 2023 is as follows, and this is the balance sheet. The liabilities are given here. The sundry creditors 10,000, bills payable 10,000 will be the external liability. So these external liabilities have to be closed, recording it on the credit side of the realization account. Next we have is Rashmi's loan 5,000. Now if you see Rashmi, she is one of the partner. So Rashmi's loan will be treated as an internal liability. So internal liability will be directly recorded in the bank account. Next we have is reserve fund and capitals. So these two will be transferred in the partner's capital account. Now on the asset side, we have cash at bank. Cash at bank will be the opening balance of the bank account. Next, we have all these assets, that is bills receivable 10,000, sundry debtors 20,000, stock 15,000, machinery 15,000, furniture 10,000 and goodwill 30,000. So in this case, they have given goodwill in the balance sheet. So the goodwill should be treated like any other asset. So all these assets except for cash at bank will be recorded on the debit side of realization account to close the assets. Now, below is the adjustment. On the above date, the firm was dissolved, and these are the assets that are being realized. The assets were realized as follows: bills receivable rupees 7,500, sundry debtors and stock at 10% less than the book value. Machinery is realized at 5% more than the book value, and the goodwill which is given in the balance sheet is also realized for rupees 12,000. So as I already mentioned, goodwill also should be treated like any other asset. If it is given in the adjustment as realized, we will record it along with other assets as the assets realized. If it is not mentioned in the adjustment, then we will treat that the goodwill value to be zero. It will not be realized, but we will record it only on the debit side of the realization account. Next asset we have is the furniture that was taken over by Geeta. So this furniture is taken over by Geeta, is the asset taken over. So this also will be recorded on the credit side of realization account under the particular partner's capital account. And next we have is the dissolution expenses that is to be paid. So it appears as a liability paid or expenses paid. So it will appear on the debit side of realization account under bank account. The last adjustment says that all the liabilities were discharged in full, which means all the external liabilities, that is sundry creditors and bills payable, are paid in full, that is as per the book value. So we will pay the liabilities in full, which will be recorded on the debit side of realization account under bank account. So with all these information, we have to prepare realization account, partners capital account and bank account. Now let us see how to prepare the realization account, the first account under dissolution of a partnership firm. So on the debit side, we have to first bring down the assets except the cash at bank in its book value. So the first asset we have to bring down is bills receivable. Bills receivable is rupees 10,000, and next we have to bring down the sundry debtors, that is rupees 20,000, and next we have a stock. The book value is 15,000. Next we have machinery. The book value of machinery is 15,000. Next, we have to bring down furniture. The book value is 10,000, and we have to also bring down the goodwill, where the goodwill here has to be treated like any other asset. Goodwill will be rupees 30,000. So the assets from the balance sheet is brought down on the debit side of realization account in its book value to show that the assets have been closed. Now, the external liabilities have to be recorded on the credit side of the realization account to close the external liabilities. So, the external liabilities we have are sundry creditors, rupees 10,000, and bills payable, rupees 10,000 as per the book value. Now, here these are the assets and the liabilities. So, these assets have to be either realized or it should be taken over by any of the partner. And these external liabilities have to be paid off or it has to be taken over by the partner. So, this realization of assets and payment of liabilities will be given in the adjustment. So, we have to follow the adjustments given here. So, as per the adjustments we have here, the bills receivable, sundry debtors, stock, machinery, and goodwill are being realized. So the assets that are realized will appear on the credit side under bank account. That is the assets that are being realized or sold, which we have to record it as per the value given in the adjustment. So the first asset that is realized given in the adjustment is bills receivable, rupees 7,500. And next we have is debtors and stock, which is realized at 10% less. So sundry debtors is realized at 10% less, which is 20,000 is the book value of the debtors, but it is realized at 10% lesser value. So which will be 20,000 minus 2,000, or that is 10% of 20,000 will be 18,000. That is the value of the debtors that are being realized. Next, we are realizing the stock. The stock book value is 15,000 and it is realized at 10% discount. So it is 15,000 minus 10% of 15,000 will be 13,500. The next asset that is being realized is the machinery. Here, the machinery is realized at 5% more than the book value. So, if you see here, the book value of machinery is 15,000, but it is realized at 5% more, that is rupees 15,750, and the goodwill that is realized is rupees 12,000, which is given in the adjustment. So we write it under the assets realized. So the total value of the assets realized is 66,750. Now here, after all assets have been realized, furniture is not being realized. But as per the furniture in the adjustment, it is taken over by a partner. So furniture is taken over by Geeta. So furniture will be transferred to Geeta's account. So we write it as by Geeta's capital account, furniture taken over. So she takes over furniture at the value of rupees 8,000. And now we have to pay off all the external liabilities. Now, in the adjustment, it is mentioned that the external liabilities, that is, sundry creditors and bills payable, are paid in full. So, since it is paid in full, we have to write it on the debit side of realization account under bank account. So, we write it as to bank account, that is, the liabilities paid off. Sundry creditors is paid at rupees 10,000, the same value what we have in the book, that is in the balance sheet. And then we are paying off bills payable, that is rupees 10,000. So both these liabilities are paid off. So we record it under two bank account. Liabilities paid off. So the total value will be 20,000 that has been paid. Now, apart from these external liabilities, we are also paying dissolution expenses. So, dissolution expenses, when it is paid, again we write it as two bank account, realization expenses or dissolution expenses, that is rupees 600. So, these are the entries which will appear in the realization account. Now, we have to find out whether it is a profit or loss, or we can say whether it is a surplus or deficit. So when we find the total of the debit side is more, that is 1,20,000. So write that same total on both the sides. So now 1,20,000 should be deducted with the total of the credit side. So it will be the loss. So loss will be by loss transferred to the partner's capital. That is, the balance will be 25,850. This is the balancing figure. This should be shared by both the partners in their profit sharing ratio 3:2. So Rashmi will get a share of loss rupees 15,510, and Geeta will get a share of loss rupees 10,340. So this is the loss which should be transferred to the partner's capital account. Now we are going to see the next account, that is partner's capital account. So in the partner's capital account, first we have to open the partner's capital account with the opening balance, that is the capitals of the partners, which is given in the balance sheet. So bring down the balance, that is by balance brought down. For Rashmi's capital is 30,000 and Geeta's capital is 40,000 from the balance sheet. Now in the balance sheet we also have reserve fund that should be shared between the partners in the profit sharing ratio. So write it as by reserve fund or by general reserve rupees 10,000 in the ratio of 3:2. So each partner will get 6,000 and 4,000. Rashmi will get 6,000 and Geeta will get 4,000 rupees. Now we have to distribute the loss. The loss from the realization account should be brought down to the partner's capital account. So it is to realization account, that is the loss. So Rashmi's loss will be 15,510 and Geeta will be 10,340. Now next we have to see what are the assets or the liabilities taken over by the partner. As per the adjustment, we had seen that one partner is taking over the asset, that is Geeta is taking over the furniture, so which we are going to bring down to the partner's capital account as to realization account, furniture taken over, that is only by Geeta, rupees 8,000. So write under Geeta's column rupees 8,000. So now this is the entries which have to be transferred to partner's capital account. Now we are going to find the total of the partner's capital account and balance it to find the final settlement made to the partners. So the credit side is more. So Rashmi's total will be 36,000 right on both the sides under Rashmi's column, and Geeta will be 44,000 right on both the sides, 44,000, and find the difference, that is 36,000 minus the debit side total 15,510 for Rashmi, which will be transferred to bank account, which is the balancing figure or final settlement. So for Rashmi it will be 20,490 and for Geeta 44,000 minus 18,340, that is the debit side total. The balance will be 25,660. So this should be transferred to the bank account, which is the final settlement to be paid to the partners. Now the last account we have to prepare under this dissolution of a partnership firm is the bank account. Now in the bank account, first let us bring down the balance, that is the bank balance from the balance sheet on the debit side of the bank account to balance brought down from the balance sheet, that is rupees 5,000. Now here we have to write all the receipts on the debit side and payments on the credit side. So the next receipt made by the partner or received by the partner is the receipt through the realization of assets. So we'll write it as to realization account, that is the assets that are being sold. So write the total value, which is 66,750. So these are the receipts. Now we are going to record all the liabilities in the order of the payment. So first we have to record the liabilities, the external liabilities that are paid. So it will be by realization account, the liabilities paid off rupees 20,000. That is the total liabilities that are being paid. Next, we have to pay the dissolution expenses or realization expenses. So it will be by realization account. Realization expenses paid rupees 600. Now, next in the order of payment, we have to pay the internal liability which we have, that is Rashmi's loan. So we write it as by Rashmi's loan rupees 5,000. It should be paid in full. Now, finally, we have to pay the partners' capitals. So we are going to transfer the capital account balance to the bank account as by partners' capital account. So Rashmi will be 20,490 and Geeta will be 25,660. The total payment made to the partners will be 46,150. So now we have to find the total of the receipts and the payments. The payments and the receipts should match with each other. So the total of the credit side, that is the payments, is 66,750 and it also matches with the receipts, that is the debit side total 66,750. So this is how the accounts are prepared under dissolution of a partnership firm when goodwill is given in the balance sheet. So please remember students, when goodwill is given in the balance sheet, treat it like any other asset. So if it is given in the balance sheet, realize it if it is mentioned in the adjustment. If it is not mentioned in the adjustment, you can treat that the goodwill asset is zero. So hope it is clear, students. We'll see another sum with the different adjustments in the next video. Thank you.